Hi everyone, I'm Karunya Rao and all eyes on ITC on today's Ideas for Profit. Well, ITC's March quarter results were in line with street expectations. The company declared a final dividend of 5.75 rupees per share, which takes the total dividend for FY21 to 10.75 rupees a share. Revenue grew 22% YOY thanks to growth in all the segments except hotels, which saw a decline of 39%. Gross margins stood at 57% versus 65% in the year-ago quarter and remained under pressure due to higher raw material prices and change in segment mix. EBITDA was higher by 8% YOY on account of tight control over employee and other expenses. Cigarettes business, which makes for 38% of revenues and 83% of EBIT for ITC, saw a growth of 13% in revenues YOY on back of about 7-8% volume growth. Innovative and competitive offerings, portfolio fortification and convenient packs led to improved market standing. ITC strengthened direct reach in target markets across all traditional trade channels and augmented the network to service rural and semi-urban markets efficiently. The company expanded its presence in 10 strategic markets with the launch of differentiated offerings to fortify cigarettes portfolio across segments. FMCG vertical, which is 25% of revenues and 5% of EBIT, saw a revenue growth of 16% YOY on the back of demand from staples, convenience foods and health and hygiene products. Segment EBITDA was higher thanks to higher operating leverage, enhanced operational efficiencies, product mix enrichment, delayering of operations, reduced distance to market and other structural interventions across the value chain. The branded packaged foods business continued to make sharp targeted investments towards brand building and scaling up its nascent categories. In the staples business, Ashirvad Atta fortified its market standing across geographies, leveraging a robust product portfolio anchored on the company's agri-sourcing expertise. Now looking at value-added portfolio, that also posted a robust growth. Instant noodles category grew well ahead of industry. It also strengthened its market standing as a strong number 2 brand within this space. The personal care products business posted a robust growth during the year, driven by several first-to-market products in the health and hygiene space, riding on heightened consumer concern when it comes to personal hygiene. ITC's e-commerce FMCG sales also doubled and they now account for 5% of the total sales. Meanwhile, agri-business, which is 22% of revenue and 6% of EBIT, saw a top-line growth of 78% YOY, driven by export opportunities in wheat, rice, oilseeds and strong growth in value-added spices. Smart recovery was seen in leaf tobacco business as well. Hotels business saw a strong sequential improvement, however, continued to remain way behind pre-COVID levels. Weddings, staycations, motorable getaways were the key drivers essentially for revenue growth here. EBITDA in Q4 was 25 crores compared to break-even in Q3 thanks to the cost reduction efforts. Moving on, paperboards, paper and packaging saw strong recovery in domestic demand and growth in exports. ITC saw strong growth in cartons and flexibles packaging. Higher offtake was seen across most end-user segments barring publications, notebooks and bedding cards. Higher operational efficiencies partially mitigated the impact of softer realizations. In Q4, ITC saw recovery in almost all segments. However, with the second wave of COVID-19, we expect some impact on the performance of cigarettes, discretionary FMCG portfolio as well as hotels and paper divisions. Better traction in health, hygiene and essential food portfolio could offset some of that decline. The FMCG business, if you look at it, has grown multi-fold over the past 2 decades with revenue from this segment increasing from 4,500 crores in FY11 to 14,750 crores in FY21, making ITC the third largest FMCG player. Profitability has been improving due to enhanced scale, better product mix, cost-saving initiatives. The management has set an ambitious target of 1 lakh crore revenue in FMCG business ex-cigarettes by 2030, which requires a 20% CAGR per annum. It wants to improve FMCG's EBITDA margins to 10% by FY23 compared to 8.9% this time around. We expect ITC to continue to remain aggressive in FMCG space and gain market share. In the medium to long term, volumes are likely to remain higher given the supply chain advantage and larger presence in the rural segment. Post-COVID, we expect segments like hotel, paper and packaging to witness strong growth and healthy profitability. Going forward, the concern remains whether ITC will be able to maintain and increase its market share in the cigarettes business in the face of competition as well as cheaper imports. ITC had stated its dividend policy and effective FY20, it planned to distribute around 80 to 85% of its earnings as dividend over the medium term, and this is what will support the valuation on the downside for ITC. We expect revenue growth of 9% for FY22, 10% for FY23, and based on FY22 and 23 earnings, ITC is trading at a PE of 17x and 16x respectively. Despite a huge discount to FMCG universe, ethical considerations have prompted some long-only investors to avoid ITC. However, for domestic retail investors, the valuation coupled with healthy payouts are a big draw.